Have you ever looked at professional trading data and just thought, wow, that looks like a completely different language? Well, today, we're going to take one of those complex, pro-level trades and we're going to crack the code together. Let's get into it.
So take a look at this. This right here is our code. I know, it looks like a total jumble of letters and numbers, but I promise you, by the end of this explainer, you're not only going to understand what it means, you'll know exactly what this trader is betting on, and, more importantly, why they're doing it in such a specific, structured way.
So how do we tackle something like this? Well, you break it down, right? Any complex machine is really just a bunch of simpler parts working together. So to get the whole trade, we have to look at its two core components. And we're going to start with the foundation, what I like to call the bullish floor.
Now, this first piece of the puzzle uses something called a put option. The easiest way to think about a put is like an insurance policy on a stock's price. It gives the owner the right to sell their stock at a guaranteed price, no matter how low it drops. But here's the twist. Our trader isn't buying this insurance. They're selling it. They're playing the role of the insurance company.
So action number one is right there in the code. The trader sold 500 of these put option contracts. This is a very specific and really important first move. So let's unpack what that actually means in the real world. By selling that put, the trader is making a really clear bet. They're saying, I believe this stock, TLN, is not going to fall below $300. And for taking on that risk, the obligation to buy the stock at $300, if they're wrong, they get paid cash right now, up front. It's exactly like an insurance company. They collect a premium today for insuring against a disaster they're pretty sure isn't going to happen.
Okay, so we've got the defensive part of the trade locked in, that floor at $300. Now let's move to the second component. This is the fun part, the profit engine. This is how the trader plans to actually make money if the stock does what they think it's going to do, which is go up.
And this part of the trade uses what's called a call spread. It's a really clever way to bet on a stock's rise without having to pay the full price. Now, the key thing to get here is the trade-off. You agree to cap your potential profit, but in return, you dramatically, and I mean dramatically, lower your cost to get in on the action. And there it is, the second action from our code. The trader is buying 500 of these call spreads, so this is the offensive play, and it's being layered right on top of that defensive foundation that we just talked about. So here's how this works. The trader is betting that the stock is going to rise above $360, and their profit zone is specifically between $360 and $400. So why cap the profits at $400? Well, think of it like this. It's like betting on a horse to win, but you agree to a smaller payout if it does. And in exchange for that, you get a much, much cheaper ticket to place the bet. It's all about managing the cost of the trade. All right, we've taken the machine apart. We've looked at the two main pieces, selling the put option and buying the call spread. Now for the really cool part. Let's assemble these components and see the full machine in action. This is where we see how the whole strategy is designed to reverse some of the typical risks of just betting on a stock to go up.
Okay, let's review the key numbers. First, we have $300. This is the trader's floor. It's the line in the sand. They believe the stock has strong support here, and they're willing to buy it if it drops to this level.
Then we have 360. This is the trigger. Think of it as the starting line. Once the stock price crosses this level, their bullish bet, their profit engine, really starts to kick in. And finally, $400. This is the ceiling. This is where the trader has decided to take their profits. They're not betting on the stock going to the moon. Nope, they have a very specific, defined target in mind. So when you put it all together like this, it just clicks, doesn't it? The sold put creates that income and that price floor. The call spread aims for those profits on the way up. And when you combine them, you get a single, elegant strategy called a bull risk reversal. It's a bullish bet, for sure, but with very specific, very defined risk parameters. And just like that, our code is cracked. So now that we know what the trade is, there's one last question. The big question, really. Why? Why go through all this complexity? I mean, if you think a stock is going up, why not just buy the stock? Well, that brings us to the real strategic genius behind this kind of trade. And this comparison says it all, really. You could just buy the stock. It's simple, direct. But it takes a lot of cash up front, and if you're wrong and the stock tanks, you feel every bit of that pain. Now look at the bull risk reversal. It's way more structured. Yeah, you sacrifice that unlimited lottery ticket upside, but look what you get in return.
A clearly defined downside and a trade that costs very little, sometimes even nothing, to put on. It's a precision strike, using minimal capital.
And that really is the key takeaway, isn't it? A trade like this is a powerful statement. The trader isn't just shouting, "I think this stock will go up." No, they are saying something much more precise. They're saying, "I believe this stock will stay above 300, rise to somewhere between 360 and 400, and I'm going to structure a bet that reflects that exact view."
Which leaves us with a final thought to chew on. Look, this strategy is, without a doubt, more complex than just clicking buy on a stock, but it offers a level of precision and capital efficiency that a simple purchase just can't match. And that brings up the core question for any trader or investor. Is that level of precision worth the extra layer of complexity? Something to think about.